Hello everyone. In this video, we start discussing chapter 15, how corporations issue securities. So we have a couple of learning objectives from this chapter as usual. First of all, we will discuss about venture capital financing. Then we will discuss initial public offering and the process of initial public offering. And we also will talk about right issues. And finally, we will differentiate between private placements and public placements. So first of all is venture capital. To be simple, venture capital is the fund provided to startup companies, funds provided to startup business. Now you can say, well, why it's particularly different or important providing fund to a startup business? You understand that a startup business is always risky. A startup business runs the high risk that they will be unable to pay back the fund raised from the market. That's why typically the conventional funding organizations, for example, commercial banks, are unwilling to provide funds to startup business. That's why there are special organizations which are known as venture capitalists. They provide fund to startup business. Now, there are a few steps you can see. Prepare a business plan. So as a starting business, you first of all need to prepare a plan. You need to submit this plan to a venture capital provider. You receive first stage financing. And as you carry on as per your plan and as per the satisfaction of the fund provider, you receive subsequent funding. Now, as I already said, that venture capital means the fund invested to a new business. So the success of this new business critically depend on the ability of the managers to run the business. And sometimes this capital provider impose restrictions on these startup businesses, for example, in terms of taking more risky projects, in terms of paying dividends, or in terms of borrowing more money. And that startup business needs to comply with these restrictions. And once the business is run complying with those restrictions and satisfactorily with regard to the profitability of the business, then the fund provider will release the subsequent funding. Look at an example here. So first stage market value balance sheet of a startup business where you have assets, cash flow from equity, and you have other assets. So total value of the business is $2 million, and the 1 million comes from the venture capital provider and 1 million comes from your original equity. So this is your first stage fund coming from the venture capital provider. Next, your second stage equity comes from the venture capital provider, which is 4 million. First stage equity value, which initially was 1 million, now increase its value to 5 million. And your original equity also, that was 1 million, now increases its value to 5 million, because you can say its market value. So as the firm moves on successfully, the value of the equity increases. And so cash from the new equity that you just got from the second stage venture capital financing, and the asset value increases compared to what we had in the previous slide. So this is the value of the firm now, which is $14 billion. Now, this figure shows the changing level of venture capital investment over time between 1995 to 2014. During the giddy days of 2000, you can see this part I'm talking about, over 100 billion were invested in startup business. But with the end of the dot-com bubble, venture capital investment slammed. You can see this period. Most venture capital funds are organized as limited private partnership with a fixed life of about 10 years. Pension funds and other investors are the limited partners typically. The management company, which is the general partner, is responsible for making and overseeing the investments, and in return receives a fixed fee and a share of profits called carried interest. Venture capital firms are not passive investors. They tend to specialize in young, high-tech firms that are difficult to evaluate, and they monitor these firms closely. They also provide ongoing advice to the firms that they invest in and often play a major role in recruiting the senior management firm. Their judgment and contacts can be valuable to a business in its early years and can help the firm to bring its products more quickly to market. Venture capitalists may cash in on their investment in two ways. Generally, once the new business has established a track record, it may be sold out to a larger firms. However, the company may decide to go public and so provide the original backers with an opportunity to cash out, selling their stock and leaving the original entrepreneurs in control. So that's the end of our discussion on venture capital investment. And in the next video, we will be discussing about initial public offering. Thank you.